Today's news is that the Purchasing Managers Index in China, which is the standard measure of manufacturing activity around the world, fell in March to a 4-month low, confirming the slowdown in the Chinese economy. That led to a further drop in the Australian dollar to just above 104 US cents. In fact, when the news came out at about 1 p.m. our time, the dollar hit an air pocket and dropped suddenly from 104.8 to 103.8, and it's recovered a bit since then. But the turnaround in sentiment about China has had quite a big impact on the exchange rate, down from 108.5 at the start of this month. The other thing that had the markets buzzing today was a big research paper from Goldman Sachs in New York, saying that shares are the cheapest they've been in a generation and are a screaming buy compared to bonds. Here's the key chart from the report. It's the gap between the average dividend yield and the government bond yield, currently at 0, which is roughly the 100-year average gap. Now, I've got to say, it has been at plus and minus 10, so it doesn't look all that extreme at the moment. And Goldman, don't forget, is apparently the firm that calls its clients Muppets. Here's another chart that was also circulating today. It shows the average profit to sales margin of US companies. As you can see, it's very high, higher even than the average in bubble years. Are profit margins really going to keep going up or even stay where they are? Investors were like stunned mullets with all this debate today, or should that be stunned Muppets? US stocks fell slightly, but elsewhere markets were steady. And in Australia, the All Ordinaries rose 0.4%, thanks mainly to gains by the banks. Resources stocks are coming under pressure because of the news out of China. And that's finance.